is not showing up properly, I'll make sure that it gets working good here, okay?
Awesome.
All right. So let me share my screen. All right. So again, Chris Price, Red Fox Multifamily. We're talking about multifamily real estate and why you should invest in multifamily real estate. That's the topic that we're going to cover today. Just a couple of logistics here to get us going. Again, please mute your lines when you're not speaking. That'll help cut out on the background noise. We ideally we could hold questions to the end of the presentation. That'll help for the flow of the content to go a lot smoother, and likely your questions will be answered throughout the course of the presentation. If in fact they're not, then we'll leave time at the end for Q&A to make sure that we can address your questions. As I mentioned just a moment ago, this presentation will be recorded, and I want everyone to know this is material does not constitute an offer or a solicitation to purchase any securities or anything here. We're just having an information share here around real estate investing so that everybody can be informed on this asset class. So let's talk a little bit about the agenda. So first off, I'll introduce myself, and for those of you who don't know me very well or just getting to know me, especially on the real estate front, but we'll also talk about a couple of key topics here that may be familiar to some, may be new to some. We'll talk about what passive income is. We'll talk about what is a multifamily real estate syndication. We'll get into why we need to be thinking about multifamily real estate as an investment, especially from a syndication standpoint. We'll talk about some strategies in multifamily, some of the roles in syndications. We'll even go through the different asset classes that exist within real estate. We'll talk a little bit about some of the typical methods for investing, and we'll go into how you can invest in these types of assets, and then we'll talk about how we can remain in touch, the frequency of these meetups that we'll be doing, etc. So here goes, guys. So let me tell you a little bit about me. So my name is Chris Price. As I mentioned before, I'm a husband. I've been married to my bride, Allison Price, for it will be 14 years next week. And we have just built a amazing thing here where we are. I'm a father to Zoe Price, who is 10, and Caden Price, who is 8. My parents and my siblings are all in the Northeast here where we reside. And I live in White Plains, New York, but my family, most of them live in the Connecticut area. I have my siblings. I have my parents are just great supporters of mine, and I think we all feed off of one another. I am a corporate leader. I'm a corporate executive, and I'll get into that in a moment, and also an accredited real estate investor. And to take a little bit more of a deeper dive on this, just to kind of give you guys a little bit of background on me and who I am. I've been a pharmaceutical executive for over 19 years. I have expertise in marketing, medical, and sales operations. I'm Lean Six Sigma certified. I have an MBA in healthcare management, master's certification in project management, and a bachelor's degree in communications and public relations. For to sum it up from a formal education perspective. But when you one of the famous quotes that I love to talk about, and folks that know me, know I use this quote often. The late Jim Rohn used to talk about formal education making you a living, while self-education, like what we're doing right now, will make you a fortune. And when I take a little bit more of a deeper dive into in terms of my self-education, what I wanted to share with you guys is that I live by this topic in particular. So I've been a real estate investor for over 10 years, with single family, multifamily syndications, invested in over 330 units. I've invested in real estate funds, multiple asset classes. So those funds cover off on apartments, self-storage, hotels, you name it. Those are the types of things in terms of improving my education on this asset class that we call real estate. I've done it. When it comes to vacant or land, I own some land in North Carolina, a little over 4 acres. And then also in terms of investing in my education here, one of the other things that I want to make sure that folks know is that, I've invested in my education in terms of various different masterminds and training programs. So I've invested in a mastermind called Cash Flow Tactics, which focuses on wealth generation through real estate and high cash value life insurance. I've invested in a training program specifically focused on investing in apartment buildings with the Michael Blanc Dealmaker Mentorship and Training program. And I've invested also in joining various different meetups, but also sponsoring this virtual meetup that we have here, which is the Wealth Mindset and Real Estate Investing meetup that we have going on right now. But it doesn't just end there, guys. When I talk about this, I like to share this slide primarily because it doesn't just stop at the education that the classroom education or attending conferences and those types of things. I live and breathe this stuff all day, every day. It's what I have a passion for outside of my family and work. I really invest in my self-education. So all the financial literacy and wealth mindset books, or mindset books in general that you can think of are these are some of the things that have laid the foundation and help shape me from an investment standpoint and just as an overall person, who I am, and they continue to shape me to this day. And that's not to mention the countless hours of podcast and other types of YouTube videos that I've soaked up over the years as well, and continue to do so as right now to be able to grow my knowledge and expertise in this class in this asset class of real estate investing. So one of the other things that I like to do to also make sure that folks understand here is that really they're when you talk to folks, many folks talk about what is the burning reason for why you go about investing in real estate. And for us, this goes back a few years, quite frankly. We were at a time in our lives where we do well, but we wanted to do better, and we were exploring different investment opportunities. And we found out at that point in time in our life that we did not have a very solid understanding of investing and on really understanding money. And if you think about the time that we all spend in and going to work and earning a living, and what we came to realize is that we spend so much time working to make money, but we don't invest any time. And at that time, we did not invest very much time understanding how money worked. And that was very problematic to us. And so we needed to take a step back and invest in all the things that I just showed you. But in terms of our why, and why we decided to go down this path of real estate investing, primarily it was focused on making sure that we can find our path of getting out of the rat race. We want to be able to live life on our terms and control things in our way. That means to us financial freedom and financial independence. So if we choose to continue to work, we can choose to do so. But if we choose to walk away because our assets are able to cover our living and then some, then we can have that choice. We also, believe very much so in spending more time with our family and friends. What was so crazy now that things are starting to return back to normal from a work perspective, or whatever the new normal is. It's striking to me how many people say, "Oh, I'm so glad to be back in the office and seeing people." And I actually take a different position. I love seeing people. I love my colleagues, but I love my family more. And when I think about the time that I've spent away from my family over the years and trading my time away for dollars and all of those things, yeah, I want to be able to spend more time with my family and my friends, to be able to help us, to just see them grow and do the things that they're doing. That is very meaningful to me. We also very much believe in building generational wealth, something that we can pass on to our kids and our kids' kids, and so on and so forth. And one day that legacy, someone will be talking about, Chris and Allison Price, one of our our descendants somewhere off in the future, that thinks, looks back at what we have been able to build and pass on to them and continue to build for generations. That to me, that type of legacy is very meaningful. We also are very passionate about building in our local communities and also abroad. I happen to have a parent who's from the Caribbean, from Jamaica, and we had a chance to go back to the motherland a few years ago, and thinking about being able to go back and help build out communities there and invest there and expand and grow. Is really something that is excites me greatly, as well as other areas throughout the world. We want to make an impact on the world to that point. We want to be able to travel more, not only in this country but throughout the world. There's so much to see in this one life that we get, and we want to be able to take advantage of it. When we think about investing, we want to invest in assets that can help create passive income. And we'll talk about that in just a moment. What is passive income for those people who are not familiar? Well, we want to be able to support our family. So, if someone has a venture that they want to be able to get into, we want to be able to help, and it makes sense. We want to be able to sponsor that and help make those investments, provide seeds, things, so that this entrepreneurial journey that everyone is on can continue to have the fuel that it needs to be successful. We want to eventually expand into other small businesses and be able to diversify our portfolio outside of the stock market, which we'll certainly get into throughout this presentation. So that's our why. And again, I thought it was important for those of you that I again, we've had opportunities to connect and speak, but I want to make sure that everyone is aware of that. So let's get down to business here. When we talk about passive income, what is passive income? Well, passive income is when you can earn money from your investments with little to no effort. So that means you've invested in something the right way, and while you're sleeping, that money is coming in. It's also known as mailbox money, or money that's just as you're taking a shower, the money is flowing into your bank account. There is little to no effort other than some initial due diligence that you put in that goes into that income coming in. Important concept, because that's going to be a key theme for us throughout this. So when we talk about what is a multifamily real estate syndication, I think there's a couple of things that you need to realize. First of all, multifamily real estate is commercial real estate, and commercial real estate starts at 5 units and up. So a building with 5 units or more is considered commercial multifamily real estate. Now, when we talk about a real estate syndication, I always tell people a syndication is just a fancy word for for putting investors' money together to buy large commercial real estate assets. So that's what we're talking about here today, and how you go about doing that. And we're gonna get into some of the details in a minute about why we want to invest in these types of assets to be able to grow and build and protect our wealth. And in particular, when we think about why, there's some really important things here that you need to really take away here. The first thing is that historically, investing in real estate is a stable investment. And when you think about investing in multifamily property, and especially being able to invest in a building in the right way, provides not only the stability, sort of absent of a lot of volatility in that you may see in other asset classes, and it has great tax advantages that the government provides. Now, if you think about this from a fundamental overall, the reason why real estate is so tax favored is because the government wants to do business with real estate investors. The bottom line is that the government wants to make sure that clean, safe, affordable housing is provided to its populace. And so they incentivize real estate investors through exceptional tax benefits to be able to help them them fund and fuel these ventures to be able to provide clean, safe, affordable housing to folks throughout the country. And so we'll talk a little bit about the tax advantages, but beyond the going deeper onto this, when we talk about the tax benefits provided by real estate investing, the fact that your passive income coming in from these investments, generally speaking, are in all cases are taxed lower or at a lower rate than your regular earned income. And then when we factor in something called depreciation or accelerated depreciation, and we start talking about being able to the tax benefits of getting and savings from your invest as an investor through a tax document called a K-1. These are the types of things that will help you will have your passive losses to help offset your passive gains, and generally speaking, help you pay little to no tax on that income that's earned from your real estate investment. So these are things that, as a part of this wealth mindset and real estate investing meetup, we are definitely going to talk more about these topics and go deeper on some of them. I'm just covering them top line right now. One of the main my favorite things, or not one of the favorite thing that I have as an investor from investing in real estate, is particularly focused on cash flow. When investing for cash flow is what most folks should be focused on. In the way that this cash flow comes in, depending on the types of investments that you're looking in, comes in either monthly or quarterly in the form of what's called a distribution. That's that mailbox money, or that direct deposit into your bank account every month or every quarter, depending on the structure of the deal that you're invested in. That's what we're talking about here, and that cash flow can be supplemental to your existing income, but ultimately the idea, going back to what I was sharing with you guys before about our vision is to be able to have the cash flow from our investments offset or overtake our earned income, and that when you achieve that, my friends, you are what they call out of the rat race. So remember that concept as we talk about this. Another key concept that's in the news every day, all day, is this idea of inflation. But the bottom line here, what you need to know about inflation, is when you can invest in an asset like real estate with a fixed interest rate on your debt, and you have on an asset that appreciates in value, not only naturally through natural inflation, but also through the value add components that you're adding to it, plus the value of the dollar being depreciated year over year. And you still are invested at that fixed interest rate. That is a hedge against inflation that very few other assets provide other than real estate. And so people saving their money in savings accounts right now are they need to be thoughtful about this, because that dollar that they're saving in that savings account is losing value every day, as we are, paying for the penalties of printing away money and adding more dollars to the system and deflating the value of the existing dollars in the marketplace. And then finally, here, when we talk about the power of leverage, there are very few assets out there. Real estate is the number one asset where you can use the power of leverage. As a limited partner coming into you leverage multiple types of things. You leverage the multifamily syndication team. You leverage the knowledge and expertise of the investment group by pooling your money with others, and they get to then leverage other people's money through banks and relationships, through property management, asset management, etc., to be able to all make this whole system work together. And then finally, when I talked a little bit about appreciation a moment ago, I think everyone that is a homeowner on this call right now can actually, look at their recent statements, or go Google on your phone, or Zillow on your phone or your computer, what your home is worth right now without you doing very much of anything. That appreciation, it exists not only in your single family home, but that also exists in a multifamily asset as well. And think about it, when you think about buildings of 30, 40, 50, 100 plus unit buildings, and the type of appreciation that occurs there, and the numbers that we're talking about. Think about what that means, and then think about that as you, as an investor, about how those winnings, if you will, get distributed to you as an investor within a particular deal. But I always like to caution people, most people, again, I stress investing for cash flow, right? Investing for just appreciation is not, is more like gambling. Folks that want to go chase different marketplaces because, the market's exploding over there, I want to go chase that. I'd caution you to be thoughtful about that, and make sure that all the right factors are in place to be able to determine where you're going to place your money from an investment standpoint. And we'll talk a little bit about that in a moment. And so what I wanted to do here is just talk about a few other reasons why multifamily real estate investments are really beneficial to you. So I talked a little bit about passive income, but passive income really is key here. So that money that you get while you're sleeping is great, but you also get to passively grow your portfolio at scale as well. And so instead of investing in one or two single family homes, or instead of actively going out there and flipping houses, or doing other types of real estate investing, you can earn money passively through multifamily real estate investing, for those people that are interested in being passive instead of active. In addition to that, staying here on the left side, you get to diversify. In most cases, you get to diversify. You'll look at many deals that will come across your table. We'll look at minimum investments of $50,000. Some may look at $25,000, but ultimately you get to diversify against different marketplaces. Meaning, if you want to invest in the Southeast, you want to be like Florida or the Carolinas or Georgia, or you can have some investments in the Midwest, like Ohio, or like in Missouri, or other markets like that, or in the Southwest, such as Arizona. That diversification of where you are investing in different assets, and the economic and demographic factors that are all formulating your investment strategy in terms of where you want to go. Those types of things are are really beneficial to help you diversify. You want to make sure that you can invest with a team that has some experience, because leveraging that experience is going to help navigate through difficult times, or even good times. When you have something going well, you want to make sure that you have a great team that is at the helm for you. We talk about protection. When these assets are, every syndicator is working, or I cannot say every syndicator, but most syndicators are working with great attorneys to protect not only the investors, but to protect themselves and to protect the asset, that everyone is. And this is following SEC laws, where investors in these assets are investing in an LLC that is formed to purchase that multifamily building. And so you'll when you get into these things, and we'll talk a little bit about that in a little bit, you'll certainly want to consult your real estate attorney for any specific advice on these things. But when we talk about risk reduction, being able to think about it this way, guys. If you own one single family, like I have one single family right now here in the New York area, that if that single family goes vacant, I'm 100% vacant. Okay. If I have 100 unit multifamily building that I've invested in with partners, and I've put in my portion of the deal, then that one vacancy isn't gonna really impact us much, and we'll get the unit rented back out in no time when we can turn it over. So the risk reduction in terms of that is worth its weight in gold when it comes to investing in these types of assets. And then last couple things, talking about investing in, on the far right here, access to large investments. There are very few people that can or will or invest in a large multifamily asset by themselves. However, there are some people that do have the means to do it, but many of them are savvy enough, and they know that they get greater returns by by using leverage and putting portions of the funds in rather than funding the entire deal to get their tax flow, their tax benefits and their cash flow. But when we come together as a syndication group, we have access to buy large investments together and do all the things that I was just talking about. And then of course we get those economies of scale and being able to build up our portfolio and the number of units across the country in a very systematic way. And that's a beautiful thing that this asset class provides that very few others do. So let's talk a little bit about the roles in a syndication. There are really two key roles that you'll want to be familiar with. And again, this is high level. There will be additional details that we'll go through in future meetups where we'll really drill down into what is a syndication. But the fundamentals of it really are focused here on limited partners and general partners. So let's start with the general partners. In fact, the general partners are the folks that are going out there. They are going and they partner together to find the deal. They are contacting brokers. They are reaching out to investors. They are doing the analysis of the demographic data. They are doing the due diligence. They are securing the loan for the property. All of the works. Put it this way: multiply what you did to purchase your single family home, and times two or three, and that general partnership team is doing all of that for the investment group. Now, that general partnership team is supported by and partnered with limited partners. Now, before I go there, now the general partners, what you should all know, these are the folks that they put together the business plan for that property as well, in terms of here's what we're going to be, and here's what we're going to do to increase the value of the asset that we are buying. Here is when we're projected to provide your returns. Here is the property management team that we've secured for this property. The general partnership group is really at the helm of driving this entire thing, and they're making sure that everyone is protected and from an investment standpoint, because the general partnership group wants the investors to win, because if they win, the general partnership group will win. Now, when we think about the limited partners are really the passive investors here, and their job really is to do their due diligence on the investment that they're looking at, and we'll talk a little bit about that momentarily. But they are completely passive, and what that comes with is you will wire your money, for example, but you don't necessarily get a say in the business plan that exists, that the general partnership group has put together for that property. You don't get a say in, guys, I don't think we need to be investing in this area anymore. I think we should be investing in this area instead. Those things, as a limited partner or a passive investor, are things that you relinquish the privilege to, if you're investing in a deal in a particular syndication. But the benefits of that is that you're completely hands off. You just simply sit back, you collect the cash flow distributions, as I mentioned before. You will get your tax documents, that you'll be provided by the general partnership group in order to file for your taxes. You will be able to benefit from all of the value of the property that occurs over the course of time, essentially completely hands off. Again, notwithstanding the due diligence that you would have done already to invest in a deal initially. So let's talk a little bit about strategies in multifamily. There are many, but the three that I decided to tease out for the purposes of this presentation are value add, buy and hold, and ground up development. And all of these are various different things. If you could, but the one that we're going to focus on for today is value add. And when you think about what a value add property is, and the reason why this is the most popular, I would say, strategy that general partnership groups or syndication groups follow, is because this has the opportunity to bring the most value to all of the investors. So what they do is they look for that building that needs a little TLC. Maybe it's been owned, it's a 50 unit or 100 unit building somewhere in the Southeast that has been mom and pop owned for, generations, and maybe mom and pop have passed on, or maybe they just haven't kept up with the times and the building is showing that. And they now, investors see that opportunity, but they see it's in a great market, because there's this wonderful Target that's been built right around the corner, and there's all these other developments that have happened, and there's schools and bustling businesses and industries all migrating to that area, but the mom and pop shop just hasn't been able to keep up. Well, that an investor finds that out, and they are able to get in contact with them through a broker and say, hey, we'd like to do our analysis, and we'd like to put an offer in on that deal. And they let's say they secure that deal. Well, now they bought that deal knowing several things that are at play to help them generate the value of the property. Let's say, for example, this particular property, their amenities in this property were just very poor. They didn't have a fitness center, but there's an opportunity for one. They didn't charge for parking, but they could charge for parking. They did not they did not charge for laundry, but there's an opportunity to charge laundry. Or even better yet, there's an opportunity to add laundry into the individual units of this multi unit apartment building, this 100 unit building. And let's say that because they were mom and pop and they didn't really, they kept their charts on napkins and paper towels in their office and didn't really keep good fine records. They didn't really track, the market rents that they have, and they've been charging, let's say, $700 a month for rent on a two-bedroom, one-bathroom property somewhere in the Carolinas. Now, what the partnership group did as a part of understanding this deal beforehand is that they know that comparable properties in that area are actually renting out two-bedroom, one bathroom properties at $1,100 per month, and they know that the amenities in that are, have stainless steel appliances, and they have LVT flooring, and they have some nice fixtures on the cabinetry. They have laundry within the units. And so they know that going in. And so what their job is to find out how do we execute a game plan to bring our property that we want to buy up to those standards so that we can bring the rent up from $700 per month to $1,100 per month to match what the market rents are currently. And when you do that, what you are doing is you are adding value by increasing the net operating income of the property. And that alone is a game changer. But I didn't even mention that, hey, we're also going to now charge for parking, $25 per month per unit that exists. We now have added laundry into each of the units that we're going to increase the unit for. And hey, if you have a dog or a cat, we're going to charge a pet fee for you to have your pet here, because we want to make sure that one, the property that we're holding is kept clean and safe, but also we want to make sure that the other that we clean up around the place to make sure that the grounds, and we have a dog park for everyone, and you're going to pay for the tenants are going to pay for that as well. And all the money that the investors put in, plus the banks that the bank money is used to enhance the value of the property. That's the value add play, and that's why it's the most popular strategy, because there are so many creative ways to drive up the value of the property. Now, let's talk a little bit about the different types of properties that exist here in multifamily real estate syndications. You have A-class properties. Think about in your communities. These are the Toll Brothers or the Avalon type properties, generally speaking, and they are typically less than 10 years old. They don't yield as much, but they certainly do hold their value in different times. Because of the quality of the product that exists. Then you have B class properties. These are really nicely constructed properties, but they may have I guess a little bit more dated fixtures, and they will be quality, but maybe not top notch like what you'll see in some of the nicer buildings in your area or in other areas. And again, I want to say these are typical things. These are not 100% um, universal. Class C properties, these are generally properties a little bit older. They are generally in little less favorable locations, but they are, they might have a little bit older finishing. They may be, a little bit varied in terms of the types of amenities that are offered there, maybe not have very many amenities at all. These are the types of things that exist in C class properties. And D properties are really, on the other side of the tracks, so to speak. When we talk about the ways that people can invest in multifamily real estate syndication, there are several ways, but I've chosen a few here for you to consider as you continue to get informed in this asset class. So first and foremost is your cash. Investing your cash into these multifamily deals is probably a number one or a top way that folks invest in these deals. But other popular ways that people invest in these types of deals are through their solo 401ks or self-directed IRAs. through companies that provide these resources to investors to help them invest in these types of assets. In addition to that, there are folks that like to partner with other investors to say, hey, let's form a joint partnership through a formal entity, and let's both of us, you'll put in 25K, I'll put in 25K, and let's joint venture to invest in this real estate syndication as an example. And then the other that I talk about here, which many people may or may not have heard me speak about before, but the idea is home equity. And what I like to say from one of my favorite folks in the real estate space, his name is Keith Weinhold. He has coined the phrase that your return on equity is zero. So what that means is that the equity that's trapped in our walls in our houses is not getting any return, and you didn't do anything to make it happen. In fact, it's happening as we speak. But as so long as that equity is trapped in your four, the walls of your home, it's not providing you any value. So what if you were to take that equity and invest it into solid assets that produce cash flow, tax benefits, et cetera, for you to help grow and protect your wealth as an idea, and not just an idea. It's a regular practice that people do called equity harvesting or equity transfer from one asset to the other to help grow their asset and their passive income. Just a way that many people think about investing in these types of things. I know I'm running close on time here, so I'm pushing through it here, guys. So thank you for your patience. Um, some other tips that we talk about for investing in multifamily. We want to make sure that, first and foremost, you need to determine if investing in real estate or investing in multifamily real estate is right for you. It's not right for everyone, and I'll be the first to say that. Now, of course, I'm a huge believer in there, and there's a lot of reasons why. But for some, there might be reasons why this is just not your asset class, and that's fine. And there are other things that you can continue to do or consider doing, going off and playing in the stock market or putting your money in crypto or whatever the case may be. But real estate investing is not for everyone. But when you do invest in a multifamily syndication, what you want to make sure that you're doing is, first and foremost, you want to make sure that you invest with people that you know, like, and trust. You want to build relationship with these sponsors that you get to know them and they get to know you. This is very important. Some sponsors won't accept money from investors that they don't particularly like, and you don't want to invest with anyone that you like. But of course, once you get past all the niceties, you want to make sure that they have an experienced team, from the partnership group and from the investors, from the partners that they have the best property management team, that they have a great legal team, that they have a great asset management team that's going to help them execute the game plan. All of those factors are really key in this. And then, of course, when you talk about analyzing, deals, there are some really important things that we'll cover off here. The first thing is that you're going to conduct your due diligence. You're going to do all the things that I just said, but there are some other things that you want to make sure that you drill down. When you invest in a multifamily syndication, you will be provided with an investment summary. You will be invited to participate in a live webinar, which will likely be recorded and then hosted for you to go watch later, so that you can review all the things and go back to things that you need to. You want to make sure that the property type and location aligns with your investment criteria. So, for example, I would not invest in places like a Las Vegas, and some Las Vegas is super hot, and people would say, "Oh, it's so great out there. Everything's going great." What I know about Las Vegas is that if something like COVID happens again in Las Vegas, then their whole industry essentially is tied up into one thing and getting people together. And if that dries up, then your investment opportunity really is at risk. But if you think about other markets that have thrived throughout the pandemic, like in Texas, in the Carolinas, in Arizona, in Ohio, in Florida, these places, in Missouri, so on and so forth. Idaho is another one for those people who are familiar. There are so many great reasons why that you want to invest in these areas, you have to do your due diligence on those things, to help make sure that it aligns with your investment criteria. And then again, when you do this, there's a formal legal document once you've done all these things that's called a PPM, or private placement memorandum, that you will sign to be able to execute and your formal agreement into investing into this syndication, to protect you and to protect the investment group, and from an asset protection liability perspective, and everyone, and from tax perspective, everything is structured properly, and that is how you will formally get into this. So I know I'm tracking close on time here. I'm going to go through these here quickly so that you can have a little bit of understanding, because again, I know most folks are familiar with investing in the stock market. And one of the things that I thought would be helpful was to provide some of the pros and cons between investing in real estate versus investing in stocks. And we'll start with investing in the stock market. So some of the pros and cons. And on the left, you'll see the cons, and on the right, you'll see the pros. So when it comes to stocks in particular, we all know it's super volatile. Anyone looking at their 401k, their IRA, or has been toying around on E-Trade or whatever Robinhood app that you're playing with right now, you're seeing the volatility and what that's doing to you right now. But on the flip side of that, what stocks provide, and they too provide passive income for those who do it right and do it well. When it comes to risk, the risk, I always like to ask people, that like to, talk to me or debate me about investing in the stock market. And I asked them the question, I'm like, can you name the CEO of the company that you're investing your money in? And many of them cannot. And when we talk about risk, real estate versus stock, I always like to serve that one up to people, because 9 out of 10 people cannot name the executives that they're relying on when they place their money in some investment from a stock perspective. And so the risk that comes with that, if the company goes, then your investment goes. And ironically, my wife and I were watching this We Crash show, and that kind of signals a little about, that was the whole story about WeWork, and that this is kind of signaling to me, hey, you got to be wary or beware of where you're placing your money. But what stocks do provide, gang, is they do provide a lot of liquidity. In fact, I had, if you want your money from a stock perspective, you virtually, depending on what it is, you within a couple of keystrokes or a couple of hours, if you have to work through your banker, you can have your money wired to you, and that is something that that other many assets cannot provide. And then, when it comes to investing in stocks, there's ambiguity that exists. When we talk about it, not many people are experts. The novice investors that are sitting on the sideline, or throwing their money over to their banker to invest for them, they're probably better off doing that than trying to do it themselves, because the novice investor is the investor really taking it on the chin right now when we think about those who are investing in the stock market in some way. But then again, when savvy investors and savvy bankers and financial professionals will say, hey, look, we're going to ride this thing out by diversifying, and we're going to put you in not so risky securities or stocks right now. We're gonna do some more mutual funds, and we're going to hold longer to put you in lower risk bonds and those types of things to help protect your losses during this volatile time that we're going through right now. And then when things start to shore up again, we'll get more aggressive. Now, from a real estate perspective, what you need to know is that there are issues on that side as well. So look at the left-hand side for the cons. When it comes to real estate, real estate is a lack of liquidity. Once you invest in a real estate asset, whether it's a single family or whether it's a single syndication, your money is tied up for the period of that deal. But you do, in that time, when you do invest in a real estate asset, you do get cash flow. And we talked about the benefits of cash flow and the tax and then the tax advantages of getting passive of earning passive income. You also have you may have a lack of diversification, but we talked about how you can navigate through lack of diversification by investing in different markets throughout the country and in different asset classes, multifamily or maybe self-storage, or maybe you're investing in hotels. Those are different things that you can do to diversify out or invest with different syndication partners. Those are different ways that you can diversify in real estate. But compared to stocks, there are some definitely advantages and disadvantages there. Tax advantages, as I mentioned, there are very few asset classes that are that have the advantages the tax advantages that real estate provides. And when we think about the government incentives that come with real estate investing, there are very few again asset classes that provide that. We talk about transaction costs. Now, typically, transaction costs for real estate investing is significantly high, going to be significantly higher than what it would be in investing in a stock in some cases. But that transaction cost can be high. There are fees. There are other things that come into play, and it's as I mentioned, your money is tied up for a longer period of time in many cases. But real estate does provide that hedge against inflation, depending on the type of real estate that you're investing in, to be able to help make sure that your money is not eroding away at all, or it is eroding away slower than if it were just sitting in your Bank of America savings account somewhere. So we're rounding up to the end here, guys, and I appreciate your time. If you'll give me just a few extra minutes, and then of course I'll stay back for questions. Some important things to do here when you talk about due diligence, which I talked about a little while ago. There are really important factors, and I'll sum it up by saying you want to make sure that you are vetting the general partnership group and their team. You're vetting the market, the business plan, the financing that they have. There's a lot of volatility going on right now. For example, what type of debt is this general partnership team securing for this particular deal? We keep hearing about interest rates going up. Do we want them in a variable rate interest rate deal? And if they are, do they have certain protections there to make sure that they're protecting the investors in this deal? What type of returns am I looking at? So this is a little spreadsheet that I put together a little while ago, to help me sort of check off what I want to, what are the many considerations. And this is not an exhaustive list, guys, but these are some of the things that I use as a tool to help me determine, when I'm investing as a passive, what are the things that I'm looking at? What year was this building built, and how many buildings is it? Is it one building, or is it a portfolio of buildings? How many units is it? How would I rate the general partnership team that I've had a chance to build a relationship with? Is it in one of the markets that I'm in? I research these markets. I spend time reading reports on the investments that are going on in Birmingham, Alabama, and in Tampa, Florida, and in Atlanta Metro, etc. I know what industries are there, and which ones are recession resilient versus the ones that may be a little more less recession resilient, and maybe not want to place my bets there, if you will. I look at the submarkets, the class of the buildings, a number of different things here to make sure that I can, protect myself from an investment and where I'm going to be placing my money. 4 more slides here, and then I'll bring it home here for everyone. The tax benefits, I cannot stress enough, but one of the things that I haven't talked about, 2 things here, is cost segregation and 1031 exchange. So a cost segregation is something that most, if not all, investments that you go into from a multifamily perspective, even single families are doing this, and right now they're doing cost segregation studies, which can help you separate out the materials that make up the property from the land, and help you depreciate the asset faster. And that's a very beneficial thing from a tax perspective that will flow back to you as an investor with your portion of the investment. Again, as a part of the series of our topics that we'll go through within this meetup group, we will take deep dives with experts that will go into the tax benefits that are here, because I know many of you have questions about these things, and I have a bevy of folks that I've been working with to queue them up to be able to come and talk to all of us to learn about these things. But the 1031 exchange is probably one of the most magical tax benefits that the government provides, because what this essentially does is it allows for the investors, for those deals that make sense to do this, to transfer 100% of the equity from when they sell that property into another property. Typically that is a property that they're scaling up, and it's 100% tax free or tax deferred. And so long as they continue to roll that equity over into different assets, or they do cash out refinances, they will the partnership group and the investors will not pay tax on that money. That is a magical thing, and again, not many assets provide that. The last things that I have here, guys, are just some key investor returns, and then I have some sample projected returns on some deals that I've invested in, that I wanted to kind of give people a little sense of what, when we talk about these things, what does it look like. But some key terms that you're going to want to research and Google later on, and in your phone, you're going to want to know what cash flow is, as we talked about. You're gonna want to know what cash on cash return means, average annual return or total return. Equity multiple is my favorite. That means, how much are you gonna double, how much are you gonna, make on your money during the life of the deal. And then another term that is frequently used, that helps people understand the value or of the deal, is the internal rate of return, which you can see the definition here. I won't go into detail because we've run out of time. But this is an example of a deal that I've invested in. And it talks about what this investment is, what the initial investment is, and what the projected returns are. So I'll cut to the chase here. But what you see on a $100,000 investment, what the team that put this deal together was projecting an 8.9 or a 9% cash on cash return, a 16% rounding up rate of return from an IRR perspective, another annual 18.5% annual average annual return, and a 1.9% equity multiple, or 2x equity multiple. The equity multiple, as I mentioned, is my favorite, because essentially that helps that basically is saying you will double your money during the life of the deal. So, and you see this represented in the projected total return. So that means if you put in 100K into this deal, you're making the cash flow, which is what you see in year 1, year 2, year 3, and so on. You're making cash flow, monthly distributions for this particular deal. But then when the deal is sold or refinanced, your principal is returned to you, plus your cash flow distribution and the equity from the exit or from the sale of the property, which brings you to that total amount that you see here, just as an example for folks to kind of get a sense of the power of this type of investment. And this is another investment that I'll show you an example of. And the reason why I wanted to show this one is because you'll see, the projected cash flow here varies from year to year. And you may ask yourself, well, why is that? And this is why it's called an average annual return. And the reason why is because if you can go back to when I was talking about that value add strategy, the group that is managing this has projected that as they're executing their business plan, there's going to be some vacancies in the property. People, when there's a famous thing or a common thing that happens, that when there's a new owner to a building, there are typically people that will just leave. And then that creates vacancies, and those vacancies create different cash flow shortages until that unit can be upgraded, turned over, and then a new tenant placed in it. So you'll see over the course of time, how cash flow may vary. But then what you'll also see is that once the property is what we call stabilized, the stabilized asset continues to kick off, a higher cash flow. And then again, you see once that cash flow, that stability is achieved, and you see the sale of the property or the refinance of the property, that all combined, the distributions plus the sale from the equity of the property, all compiles into that 91K that gets you your total overall return. So that is it, guys. I thank you guys for staying 8 minutes over. This presentation will, is being recorded. I will post it up on the Wealth Mindset and Real Estate Investing YouTube channel, which is being polished off and finished off here in the next couple of days. And we also, if you want to talk to me more about this, you can shoot me a text. For those of you who have my mobile number, I'm happy to talk to you anytime about this. And for those of you who don't have my information, if you want to type out on the link there and find me and schedule time with me, please go ahead and do that. But I'll stop now and see if there are any questions that I can answer for folks. Any questions or comments or things that I can answer for you guys? I know you've given me 9 extra minutes.
Hey, Chris, I have a question.
Yes, sir.
When you invest as a LP, as a limited partner in a deal, for how long will be the money tied up into a deal usually? How long will that?
Great question, Giovanni. So typically in deals that I've seen, deals are average out between 5 years being the shortest amount of time that I've invested in a deal, or 7 years being the longest that I've had. But you may see different partnership groups offering shorter terms based on what the business plan is and based on how quickly they can execute their game plan. So I've seen some deals as short as 2 years, for example. And then another way to answer that is that I've also seen deals where the deal may be a 5-year hold, but they were able to achieve their projected returns in 3 years, and so they sold in 3 years, and they were able to provide the investors their investment and meet all their investment terms in the shorter period of time, and so therefore they decided to sell that deal, get out of it, and continue to move on into the next deal.
Right. Thank you, Chris.
Yeah, no problem. Great question. Any other questions or comments from folks before we break here? Well, look, I will not force the issue here. Many of you know me. Please reach out to me if you have additional questions and you want to speak privately. I'm happy to do that, to go through any of this in more detail. Please know that we will continue to deliver great value through this virtual meetup. We're doing them virtual right now. Maybe one day we'll be able to get people together in a common place, but we're doing another meetup in 2 weeks. We will have another meetup it is the 7th, excuse me, of July, where we're going to be talking about what is a real estate syndication. So we're going to go actually into more detail on this, and we'll get into the specifics around what a syndication is. And then later on, we'll talk about some other topics related to this so that people can continue to learn and grow about it. And then again, bring your questions, bring your friends, your colleagues, anyone that you think may be of interest have interest in this, and we'll continue to grow together. So thank you guys for your time.
Thank you, Chris. This is great.
Thank you, Chris. Have a good night.